We're very grateful today to have one of our committee members presenting in our first event of the year. So Professor Maggie Chen from the University of Cardiff, who does a lot of work in finance, and the area she's selected to talk to us today is about the behavioural fingerprint of traders in the Bitcoin market. So with no further ado, I'll pass over to Maggie. I'm assuming she's okay to take any burning questions you have during the presentation, but we'll have a brief question and answer session towards the end of the session as well.
Yeah, thanks, Rob. Yeah, we were discussing earlier, because the meeting is recorded, and if people ask questions, they may not want to be included in the recordings. So we try to keep the last 15 minutes for questions. And I possibly won't be able to look at, attend the chat function until I finish talking, but I'm sure it will work out very well. Okay, hi everyone, I'm Maggie Chen from Cardiff University. I'm currently based in the School of Mathematics, but actually by training, I would call myself a financial economist. So most of the work I do now are interdisciplinary, including this one. So you possibly will soon identify that, the main interest of mine is to take some kind of solid, often quite, theory-proved method to apply to some real-world driven financial applications. Yeah, let's get on with today's talk. And you can see that from the title, I'm going to talk about Bitcoins. Okay, this is quite a hot area, as we all know, because the Bitcoins is no longer something kind of alien. It becomes quite known to the public, whether you trade it or not. But we try to look at in this project, that's with my colleagues in Cardiff, Arman Ashraghi and Hussain and Anchi, is to look at the behavioral side of things. So we're looking at how the Bitcoin traders behave through looking at the transaction records, instead of go straight to some kind of familiar variables that finance people like to use, for example, stock prices, volumes, etc. And I'll explain why we do so and how we are motivated for that. Okay. Yeah, the content of today is quite straightforward. I will say a few words about the Bitcoin market and how we see it, and that leads to us to look at the demographics from the behavioral fingerprints. Then I will briefly go through the literature. The literature is not very big, as you can imagine, because really the Bitcoin start to pick up the attention possibly after 2017, although it's been existing since 2008. And so the literature is not quite large, but it's fast growing. And when I talk about literature, I'm more talking about Bitcoin as investment asset. So I'm talking about the finance literature of Bitcoin. And, this is not to say that the literature on the blockchain technology, etc., hasn't kind of developed. That possibly there is a vast majority, vast literature out there. And then what we're going to do is to focus on the key theme of the paper or the project, to look at why we do a classification of Bitcoin traders through their behavior transactions, and then I'll present the classification results. So that's the rough plan. So the first part is a little bit about the Bitcoin market. Sorry if I make this slightly smaller. You can see the whole. Yeah, okay. We all know that as a currency, the main function of it would be purchasing power. And the cryptocurrency, by design, was to fulfill that purposes. And it is kind of possibly by the original design considered to be categories of commodities, and has purchasing power. It will work like a currency, and it will be binded by monetary or fiscal policy, and it will have impact in terms of taxation, exchange of currency, or any areas of banking. But even up to this day, we know that we actually don't have many venues or resources or sources that would easily allow any kind of individual to purchase goods or services or exchange this using Bitcoin. And it's growing, but I don't think it is functioning like a currency, like a pound or dollars or any of the currencies we're familiar with in our real life. So in that sense, in fact, what we find about Bitcoin is that it, instead of actually fulfilling its mission of being a currency, it actually kind of more active to be used as an investment asset for speculative trading, particularly. I will say that in a few moments. And what we did is we did a kind of before we actually dig into the project, we actually just did some snapshot search to prove what we're trying to say. So we just extract a few things. So, for example, we look at the currency against Bitcoin that give you kind of exchange rate, and the foreign exchange rate, etc. And you can see that we have the exchange rate between pound and dollars, and the Mexican dollars and USD dollars, and then you can see we have done the kind of quick check of USD against Bitcoin. Even just from the very basic price kind of chart, you can figure you can see that they possibly move slightly differently, the trend wise. And then if you look at the basic, return stats of the series, clearly they are a bit different, right? If you look at the mean median of this kind of crypto exchange ratio against the real currency exchange ratios, and they are very different. And especially like the range of max and the means are very different. Skewness wise, quite similar because they're all like negatively skewed, but kurtosis are at different levels, and standard deviation, which usually is the first indicator of risk we look at, is very different. Then we compare that ratio to some kind of quite liquid stocks, but well known to be kind of high risk stocks. Again, we just have a snapshot check, and we see that they possibly, comparing to the currency exchange rates, this kind of new crypto-based exchange rate possibly behave more like highly speculative stocks rather than the traditional currency. So that's just to kind of give us a little bit verification of what we're thinking, that the Bitcoin possibly is more used to be to be investment vehicles rather than really carrying out a function of a currency. And then what we when we look at this is that we notice this market structure is very, very different. Okay, so to the conventional stock market, it is 24/7 market, and it is based on decentralized blockchain technology, which often grants very easy access comparing to the conventional investments, and the transaction fees are usually lower on this. So that means in this market, the different types of traders would be much more diversified and wider user groups. And from the real observation of Bitcoins, we can see that the prices tend to be more price movement tend to be more volatile, and there are a lot of speculative opportunities to gain high returns within that high level of risk range. And also the underlying distribution of the Bitcoin prices would be far from normal. We'll see that in the later slides. And if we look at some technical side of things, because we know the Bitcoin is organized, that the transactions of Bitcoins would arrive and they would be organized into blocks, and then you will have miners to mine this. So whether you're buying or selling the Bitcoins, and the transactions will be submitted to the system. And then there will be miners who will mine these transactions to match them. So only when the transaction is mined and verified, it wouldn't become a kind of a trade. So it kind of works more like an order-driven market. But in order-driven market, we possibly wouldn't see the very distinguished roles of miners. So you don't really have a real person there to just sitting there to mine and then to kind of go through a mining process to verify a trade. So trade basically are automatically matched from buy and sell sides in the traditional order-driven market. But in this market, you actually have a whole bunch of miners compete to mine through all the transactions in the block and then try to win that block. And they will get then paid by them if they win it, and they will be rewarded with mining fees. That's exactly where they make money off it. And according to the blockchain design for the Bitcoin market, it actually had the mining structure is very, very structured, organized. So the arrival of transactions into the block usually take 10 minutes to fill a block. And that resulting roughly every day, possibly there will be 144 blocks available to accommodate all the transactions. So this is to talk about the current capacity of the Bitcoin market, and which has been incredibly expanded since 2017. So before 2017, this market was not quite active, but since then, and more and more people start to enter into the market, and it start to become quite attractive. So this figure here is to give us a kind of a brief idea of the average number of transactions per block. Like every day, the average number of transactions going into the blocks since the kind of almost the birth of Bitcoin up to roughly now. And you can clearly see that the mining the hash rate, which shows the power of mining transactions the power of the mining transactions start to pick up very, very quickly. So this actually also shows that this market starts to become kind of incredibly popular within a very short space of time. And regulation-wise, it wasn't picking up much attention until very recently. Possibly a lot of you have heard of the ban on cryptocurrency mining in last year. Actually, the official ban was announced in September, but there was a whole series of actions taken by the Chinese government to warn the miners and the traders that the transactions would be suspended. And I say pick up this ban simply because possibly the China's cryptocurrency markets, particularly for Bitcoin, forms the largest market in this area. And this is another snapshot to show what I said earlier. Since 2017, you can see the blue line is the transactions per block, and then against the price. So you can see that the market become quite active because more transactions started to appear, but also that's accompanied by more volatile price movements here. And because it is based on the blockchain, decentralized finance, and so there are suddenly a lot of the emergence of a lot of exchanges as well. The most famous one possibly would be Coinbase, which is actually officially confirmed, or you can see that as a listed Bitcoin kind of exchange. And in terms of trading volume, is possibly the largest in the world. And I'll talk a little bit more about the regulatory side of things while we go along. Okay. from the snapshots, I've already mentioned that there's a significant increase in the number of addresses. When I say number of addresses, I mean when people basically like accounts or traders, but because it's a cryptocurrency traded via the platforms or virtual trading platforms, they have to register. So the addresses will be recorded. So here, basically, I use addresses, accounts, or traders kind of almost interchangeably. So the number of addresses have dramatically increased. So here is just some numerical evidence to show that at the beginning of 2018 to the beginning of 2021, you can see that the number of addresses existed in the marketplace definitely being doubled or even more. And what we did is we actually take all the transaction records of all these addresses and then try to identify the behavioral patterns. And you can see that this is quite a massive data set. But the interesting thing is that after we do all the mining, the first thing we realized that actually majority of those addresses don't or won't make a big impact on the system or in this market space. I will come back to this, a lot more later on when we classify the traders. So pretty much majority of these addresses are very inactive. And throughout their lifetime, they possibly don't trade more than 2 transactions in total. And it's almost like they come to the market to dip into it to see what's going on, then left, and then suddenly one day they probably are interested again and come see again, and they disappear. They don't sit in the market and trade constantly. Only less than kind of 9% of these addresses are actually trade with certain features, and that's what we're trying to look at. So I'll give you an example. Among those less than 9% of traders, they have very distinctive trading features. You can possibly imagine, in contrast to those highly inactive traders, there will be highly active traders. So this is one example. So this address registered on the 28th of October in 2017 and appeared in the block number, this block. And if you trace all their transactions up to end of January 2021, like what we did, you will realize that on average, this guy pretty much do about 87,000, more than 87,000 transactions per month. And since the registration date to the end of January 2021, he's done more than nearly 3.5 million transactions. Because comparing to those, who throughout the entire period only do 2 transactions, they are a bunch of guys who are extremely active in this market. Okay, this is kind of rough background we're trying to kind of look through. But how do we come up with a research question? We dig into the literature. So I'm not going to bore you with all this, papers, but I just want to say a few things. So, as I said, while the market become more and more attractive, then the academic literature regarding Bitcoin as investment asset starts to grow, and people pretty much have focused on a few areas. The first one is the market microstructure. So people are asking questions whether the price behavior or the price volatility or return behavior, or in terms of their trading volumes, they have any similarity to what we know of the high frequency tradings? Because it appears from the price movement of the Bitcoin prices, the price movements are quite frequent. It looks like they behave like the high frequency traders, but are they really behave like high frequency traders, and how heavy do they trade, and things like that. So there are a whole bunch of literature to look at this, and then also they would then draw implication of how whether Bitcoin can be used as a hedging tool as well. And then the second part of it is to look at the market efficiency side of things. So people are trying to apply the kind of very classic pricing models or volatility models to look at the Bitcoin prices and the volatilities. And obviously, the third area is that while people, spotting the Bitcoin price movement, which they saw a lot of spikes, and then they, your first reaction to that is, okay, that doesn't look like volatility only. It looks the dramatic change of the Bitcoin price movement. Let me just remind you quickly here. You can see that. So some kind of the dramatic price hikes possibly are not just volatility. People start to think, okay, would there be financial jumps, or would there be a lot of bubbles in this kind of area? So there are different people, researchers looking at it, and a few of them find that there are quite a lot of short-lived bubbles in the Bitcoin prices, and usually this price bubbles would generate some kind of rewards, and therefore form a lot of kind of speculative opportunities for traders. But after going through all this literature, we have some questions. Okay, so first of all, we know that Bitcoin market has benefited from technology advantages, and especially nowadays, with Internet of Things, and people have very easy access to apps and trading platforms, etc. And also, the automated trading or algorithm trading or electronic trading made the trading cost lower. So trading is no longer something that only belongs to the professionals. So anybody like you and me could, say, for example, register on eToro, do some trading, buy fractional shares, etc. And often, we start to see that with the new financial innovation accompanied by technology advancement, often you will spot some new financial innovations with potentially high returns, which means they possibly carry high risk, but there are a lot more opportunities for speculation. So that's the first thing. This means that we often observe the Bitcoin prices, has extreme volatility. So I'm pretty sure there are people in the audience familiar with some kind of media news when Elon Musk tweet something about Tesla going to accept Bitcoin for purchases, etc. The Bitcoin price is shot up, things like that. So you can see that in this market, because of the technology allowing a lot of access and a lot of kind of online platforms, and the trading of this kind of new financial innovation is not only just driven by the underlying process anymore. It seems that the news, sentiment, momentum, and all play a role in the trading. So in that case, what we're thinking is that, can we just observe the price, and in order to understand how the Bitcoin trading actually works? Because the prices could be artificially or spuriously inflated. So is the trading volume and the liquidity spreads. Another issue is that, in this area, the regulation is not up to speed. Okay, there's lack of regulation, and the understanding of how to regulate the trading itself is almost non-existent. So there was a hedge fund based in New York, and the BSE asset management was asked by the SEC to do some market research. And they actually in 2020 submitted a white paper document to SEC to apply for the Bitcoin and ETFs. The argument is that there are a lot of exchanges which are spuriously making or artificially fabricating the trading volumes to make the trading or marketplace look quite active. But in fact, the market itself is very unorderly. So they're proposing to have ETFs, which is exchange traded funds, and that has to be, if that works, that has to be under some regulations. So they actually propose to have the Bitcoin ETFs. As I know, the first Bitcoin ETF was actually officially approved, I think later October time last year. So in the system, we just think, if there are a lot of the spurious stuff going on, can we truly trust, what the prices tell us? Is there any other way that we can understand how this marketplace operates? That's pretty much the motivation that drives us to look at the behavioral side of things. And another thing is that when everything is recorded in the this Bitcoin blockchain system, it will go into memory form, and it will be kind of recorded as a sent or received address. That means, for example, if I'm trading Bitcoin, I buy and sell. Obviously I will buy and sell and hold. But every time, even I'm the same trader, my sent and my receive address of coins would be recorded. They will be considered as different transactions. That's another reason why in this system, the number of transactions would be huge, and also it works as more or less like an order-driven market. And in that situation, we also have another layer of miners coming who will look at the sent and received address IDs to match the transactions in order to verify the transactions in blocks. So the infrastructure-wise, it is much more complicated than the traditional order-driven market. And we just think, the behavior of how people actually buy or sell would be something fundamental that will help form the prices of the Bitcoin. So the questions would be, who decide the Bitcoin prices, hit the 65, just under $66,000 historical high, and then who decide that the price a few days later dropped to about 40,000 marks. How does the price formation actually work? We don't know. This is quite a big question to ask, and nobody knows. But what we think is that, first of all, the buy and sell side of things of the transactions, which act more like quotes, would be highly relevant. In a traditional order-driven market, we know that you have a buy and sell side. They represent supply and demand of the market. And only when the supply and demand meet with each other, the trade is struck. And we know that the more quotes exist in the market, the more likely the trades would occur, right? So that's just the basic, the rationale of the order-driven market. So it would be the same. So we would like to really go in to see what the transaction level would tell us about this market. And this is well related to the market microstructure area. So we want to know how the buyers and sell side work and how that would affect the demand and supply of the Bitcoins during the trading. And then that possible will be very informative of how the prices can be formed. Okay, I'll explain how we did that, but before that, I like to go through the key findings. So basically, we go through all the transaction records, and then we apply some algorithm based on k-means, and after some robust tests of different features, and after multiple runs, and we can clearly identify 5 distinctive trader types. And they all have their own unique features, and we then compare them to the conventional, the equity markets, and then try to understand their behavior and the strategy the patterns. Okay. Just quickly to go through the structure of the model setup. So in Bitcoin market, we have number of transactions, total number n transactions, and these transactions come from n different addresses. It could be sent, it could be buy, and they will all be put into blocks. Okay, so when you see M, that indicates something information about blocks, and capital N indicating things about transactions, and small n indicating things about trader ID addresses. And in Cardiff, we have a registered structured Bitcoin database in a business school called Qubit. So we pretty much take the transactions from there, and then the entire data is from the 1st of January 2018 to the 31st of January 2021. And here we define the number of transactions for any address I, and the number of blocks that this address I had transactions. And we can look at the block date of the J's transactions for this address, and block time of the J's transaction for this address. So I just want to say that in terms of timestamp, the transaction timestamp will be identical to block transaction stamp, because as we said, in this market, only if the miners mine your transaction in that block and verified it, and it wouldn't be considered to be a successful transaction. That's why, the successful transaction timestamp would be that block timestamp. Now we also look at the number of transactions of this address at a day level, at week level, and at month level. I'll explain why we do so. Then we define all kinds of features, but after numerous experiments, we find 11 different features that could help us to identify different types of traders. So the first 4 are about the trading frequency. So we are looking at the number of transactions per block, the average number of transactions per day, per week, and per month. And then we didn't report per month because per month results are very similar, give us quite similar conclusion in weeks, but we do report the standard deviation of the number of transactions per week. So all these 4 are telling us the trading frequency or the transaction frequency of an address. Then we have another 3 features to look at the waiting time. So how long do we wait between transactions, etc. So we look at the medium transaction time intervals and in weeks. And then we also look at the relative range of transaction intervals. That's the interval between address I between 2 different blocks, and then that will be kind of discounted by this mean level of intervals. So it will give us a range of transaction intervals, and then we look at the standard deviation. Then we have another 3 features to look at how active the accounts would be. So we would look at the active time ratio of account throughout the entire life. And we also look at transaction days to the lifetime ratio, or transaction weeks to the lifetime ratio, and transaction months to lifetime ratio. Then what we did is to put them into k-means algorithm, and you can calculate based on different features of address. You can then find the central node, and then you can calculate the Euclidean distance in order to kind of group them in. To group them. So pretty much go through the k-means clustering. We can, by distance measures, we can group different features for address in order to classify all the addresses and see what groups they fall into. Okay. As I said, we have this data set, and we exclude all the addresses that has less than 3 traits or shorter than 1 minute active time in the database. That gives us this much addresses already. And then what we did is we take all the transactions arriving at blocks and then try to fit them to a Poisson distribution and then plot the QQ plot. And you can see that the block arrival QQ plot fits quite well with exponential distribution, and then it works out from the real data. We see that roughly the miners will take 9.33 minutes to mine a block. By design, in theory, it should be 10 minutes, so it's close. And here you can see that it's new trader arrival. That's to show the accounts or addresses registered into the system. And you can see the histogram, you can see the new trader arrival, and that has a seasonality here. But most of the accounts existed, the active addresses we're using, you can see if we dig into it, most of them registered after 2017. Okay, then with all this active work addresses we look at all these 11 features. We have 5 classes of traders. I'm going to do this in a reverse order. So basically, we find 5 different types of traders through k-means. We are aware in the machine learning literature, you could have different methods to naturally tell you how many classes you could classify. But we go through the transaction records and then repeat different features until we get robust, until all these 11 selected features are robust, and that yields 5 different type traders. We call them text traders. They're like casual traders. And we also have fundamental traders. They are the typical value traders providing liquidity, and they trade quite frequent. They trade quite consistently. We also have particular liquidity providers, which we'll look in a minute. And we also have the proper liquidity takers. They are very much the informed traders. How do we see these 5 different ones? We do that by looking at the 3 sets of features. They're 4 on the trading frequency side. As I said, the transaction level stuff that indicate how frequently trades are occurred. So, for example, we have a number of transactions per block, per day, week, and the standard deviation. I'll give you some examples. So, for example, this is the casual traders I was talking at very early on. That counts about more than 90% of the total addresses we have had in the sample. You can see that the number of transactions per block is only 0.18. Even without knowing what the rest of the groups are, you can compare that with the numbers. This is quite low. And if you look at their waiting times, usually the median interval waiting is 163, nearly 164 hours before they strike another trade. So, and also you can see that they don't trade that actively per day because their transaction to lifetime active ratio at the day level is very low. But they also don't kind of just disappear. in the system. They seem to kind of register and then they don't trade very often, and then they just stay there. But their impact for the entire system is also quite small. Okay, so for later on when we do case studies, we actually don't look at this. So they have a large amount. There are a large amount of traders are like this in the system. Whenever they trade, they actually are like the casual traders or casual traders in the equity market. They possibly provide liquidity to the market, although not very often because you see their waiting time is very long. The second group is what we call fundamental traders, or you can call that value traders. You can see that they are still quite, among the rest of roughly 9% of traders, they are the largest group, okay? And their transaction per block is not quite small. It's quite close to other groups, although it's the lowest. But the waiting time is kind of fairly long comparing to the others. Although they're quite close to the last one, but the trading purposes are very different. We'll talk a little bit more about that. But if you compare this to, group 3 and 4, they actually wait about 4 hours. So that means almost they trade twice a day, kind of things. And if you look at their average and active ratios and actually look comparing to other groups, they look quite healthy. Especially they are quite similar in many ways to group 3 and 4. Okay, but very different from number 5. We'll talk about 5 later on. So the active kind of time against the lifetime is kind of in the middle level. Okay, and this group of people, and you can see that they trade intraday, fairly medium frequency. So they are quite consistent. Then we have numbers 3 and 4. Both have quite a similar waiting time between the transaction, of the transaction intervals. They are the people who actually we think provide a lot of liquidity to the market. So basically, roughly this kind of indicates like every 10 minutes they struck a transaction. That is something traded in this group. And you can also see that the number of the transactions per block, per day, per week are all kind of pretty, strong. It shows they trade quite consistently. So we think these two groups of people are quite, frequent, are the liquidity providers. Obviously, they are very different. For example, group number 4 seem to be the people who tend to do slightly bigger trades comparing to group 2. The last group is the most interesting group. They're almost the smallest group of people, but they're quite active. If you look at their number of transactions per block, they're almost at the top. And then they wait a little bit. There's 0.46 hours to trade, but the range of intervals is far bigger than any of other groups. Okay, that shows that they actually are waiting to trade purposefully. And if you look at their active time percentage ratio, they're very active. So they stay in this market. They don't exit market, and then they purposefully trade. And yes, you could wait because you're kind of looking at the market trend, etc. But unless you know what you're waiting for, you won't wait for this long to trade. So they look to us are like the technical traders. I possibly will skip all this, but just quickly to say we did look at some histogram of the transactions. You can see that these 4 groups have very different histogram or distribution. We did the same to look at the median or mean the level of waiting time. Again, they have different features. And the number of active blocks, histogram, they have different features. I just want to say a few words about the last group, the technical traders. If we pick up a case study, address in this group, and you can see that if we plot the price of this kind of address, and then we plot the total balance, and this is the daily volume, and this is the number of transactions. If you pick up any kind of stock, very liquid stock, and plot the price movement, you know, and compare that to it, you know that this crazy noisy patterns is not normal. It's almost this person has a neutral position, then trade, has a neutral position and trade, almost like he does this, you know, it's almost like he's doing buying, selling, neutralize, trade, neutralize position. So he's basically trading and hiding at the same time. He doesn't want the market to know what he does, but he wants to do what he does. He wants to do in the market. And if you look at the volume, again, this is not a random volume, right? You can clearly see this spikes, basically accompanied by a lot of neutralized positions in between. And the transaction pattern is just really noisy. And this kind of people are really, you know, as I said earlier, possibly are not the random traders in the market. They're trading with very strong purposes. So we pick up this particular address. Well, sorry, we pick up another particular address in this group. You can see the patterns of those two, and they have some trading going on. Then they just stay put. They don't do anything, and then they trade. So almost like I have a PhD student who used to work for Goldman Sachs, and he told us he basically at the beginning of the day he trades, and they go out for coffee, whatever they do, and then they wait until the signal comes just before the closing bell, then they trade. And during the day, they only just wait there to kind of accumulate their basket so that they can, you know, all dump into the market at the end of the day. That's another pattern. So from this two, we can see that this really, you know, whether our classification should be 5 or there will be, you know, other more robust way of looking at it. But what we do know is that there's a small portion of traders who definitely trade with some strategy. Either they're doing information arbitrage or speed arbitrage or whatever strategy. They are dominating the market with a strong purpose. And this is actually quite consistent evidence to the BSM, which I mentioned, the company in New York who proposed to the SEC and CFTC to start Bitcoin ETFs. Okay, they also identified, you know, the real Bitcoin exchanges like a Coinbase and a few others, you know, who they consider are the speculative Bitcoin exchanges. So I'm going to stop here to just quickly sum up is that we basically just think, you know, this is a very new market. And the problem is that the prices, volumes, or liquidity spread, you know, those indicators we normally use are heavily inflated and sometimes can be quite misleading. And that's why we think if we go back to the core to look at transactions, especially when the market is kind of established based on kind of order-driven market structure, that we really should go down to look at how the transactions tell us. And that's why we went to identify different traders. And we know that different traders have their particular trading patterns and trading strategies. And they're usually highly indicative to the market. And so that's why we think there's significance of doing so. But is this the ultimate thing to help us understand the market? No, not really. We have a lot of things to explore. So, for example, we only looking at the transaction. We want to really know how this transaction level things are connected to the trader's wallet, and whether that, at the wallet level, the real money level, whether they show the same picture. And we also want to know the role of miners better. So, for example, whether the miners have, great power to mine or hash rate, and can mine through very difficult networks, have trading advantages. So there are a lot of unanswered questions, but we just thought this possibly is quite cool to start with. Okay, thank you. I'll stop here.
Okay, Maggie, thank you for that. It was fascinating. So if we got any questions, you can either raise your virtual hands and unmute people, or if you're in the chat. So I can see Enrico. Do you want to unmute yourself and ask a question?
Hi, can you hear me?
Yes.
Yes, thank you very much. Hi, Maggie. So I wanted to ask you a quick question about the arrivals. So you were mentioning that they were exponential or Poisson. So are you considering the number of arrivals or the inter-arrival times?
No, it's actually the actual arrival of transactions, the number of.
Okay. Yes. So that's interesting. In this market, it's exponential. Okay. Thank you very much.
By design, they design that it will be, the block will be mined through 10 minutes, and arrival should follow a Poisson distribution. And so the real data shows is about 9.33 minutes. Yeah, so to be honest, I do not know why they were designed this way. So for some other, cryptocurrency like Ethereum is designed to be mined through only using 13 seconds, but they don't really track a lot of tension like Bitcoin. As I said, this is we just had a PhD student starting and another one to look at how the technical design, infrastructure, governance actually relates to how they perform financially. I don't know originally why they designed this way. Yeah.
Thank you.
Okay, we've got a question on the chat, and then we'll go to Nikolai. I'm trying to keep it in the order they're coming in. So, Paul asks, "Is it possible?"
From Cambridge, please.
No. Sorry, I do the question in the chat first. So Paul asks, "Is it possible that a single person or organization could have more than one address?"
Yeah, it is very likely, and that's why I said, possibly, after this, we would need to go for the wallet level. It is a bit like the high frequency trading. Your transaction IDs are very different from from trader IDs. What we don't really know. Again, as I said, I don't know enough yet about the whole design. So what is the unique identifier is in this market? So far, we think possibly wallet is unique, because whether you are sending or you're receiving, whether you register one or two different, eventually they should possibly all combine well through the wallet. But whether one person or organization could have multiple wallets, then that could be also an issue. To have the unique identifier is very important. That's something to be explored. Thank you.
Okay, Nikolai, you had your hand raised.
Yeah. Well, it's actually me. My name is Elena Boguslavska. I'm just here in Cambridge with Nikolai. So my first question was exactly the same. Well, I know that different organizations can have different addresses, and to my knowledge, it's actually people do use different addresses, especially if they don't want to be tracked. So in Bitcoin transactions, if you don't want to be tracked, then you do use multiple transactions. And because this is the only source of some anonymity for them. So that's so that's the first question. Comment probably, yeah. The other one that you talked about, liquidity, and to my understanding, I haven't studied the Bitcoin markets, but as far as I understand, in Bitcoin, the average transaction takes 10 minutes, right? So how can you talk about HFT in such markets?
No, we're not talking about HFT in this market. We are trying to classify trader types and then see, for example, whether some of the trader types behave like HFT. So, for example, in our trader 3 and 4, we from their behavior, we think they're more likely to provide liquidity rather than taking liquidity. You see, this is trader 5, okay? They don't trade very often. They trade with large deals, and then they trade with purpose because, for example, their range of the intervals is very long, so more than 2,000 something. So apparently, there's something they're looking for before they trade. So they're not going in to create trades or transactions so that the market remain liquid. They're actually taking, it's quite purposely using what liquidity available in the market. So in that sense, we're trying to see whether these features show that they are using or consuming liquidity. That's liquidity consumption or liquidity creation is kind of concept coming from the market microstructure literature. And obviously in that literature, the typical example is ultra-high frequency trader. But we all know that, ultra-high frequency trading was popular. Now people actually, it's quite costly to do so. So you possibly now do see a lot of intraday trading, which are not necessarily very high frequency. So we're trying to draw analogy with not
very high frequency.
Sorry?
Well, you mean Bitcoin?
No, we're not saying that. We didn't see whether they are high frequency traders or not. So if you look at if we look at the medium interval of transactions, so you can see that the group 2, 3, 4, 5, especially group 3 and 4, they take about 0.19, 0.16 hour to have the next transaction. So that roughly turns to be like every 10 minutes they possibly have a transaction. Things like that. Well, we're not saying they are high frequency traders. We're saying whether some of them behave more like, but
okay.
again, high frequency traders, whether they are liquidity creators or liquidity takers, there are a lot of debates about it.
Okay, so basically you're saying that because the time for creating transaction is 10 minutes, so this is basically the minimum. It can be sort of approximately. So this is the minimum time they can make a transaction. If those who trade 10 minutes, so they are like high frequency. But then for high frequency, you have huge data, isn't it?
We're not saying any of those are high frequency. We are saying the medium of the transactions intervals is around the 10 minutes. So if you really put me on spot to ask that, I would say they're more like intraday traders. I wouldn't even call them high frequency traders.
Okay.
Yeah.
Sorry, I'm just we've got questions coming in. I'm just conscious we're getting to the end of our time, so I'll try and give you a couple of these quick. So Wang asks, basically, interesting data set. Is it publicly available or is it from a company?
It is. All these are public available. So basically, one of course is Hussein. He's a computer geek. He took all these things and like address, transaction sent, receive address, etc. from different exchanges. They're all openly available, and then put together a new database. We call that qubit. So he basically set up a different layers. You can trace to every single address, and for each transaction, you can trace all the transaction records sent or received at what time, what day. But the wallet data, as I know, although they're open, they're not easily retrieved on these. That's one of the challenges because we can all get Bitcoin prices or look at the hash rate, etc. on say Coinbase or Coinbini or blockchain.com, but most of this are not structured enough for us to be able to kind of model them straight away. This is not really for academic use.
Yeah, okay. Rune asks, says, thank you for the interesting talk. A trade is capable of having multiple addresses, even thousands of addresses.
Yeah.
Did you only do clustering on individual addresses, or did you attempt to link multiple addresses?
We didn't link. This is the very first study. We possibly came in just with very straightforward question. Haven't got to that stage yet. But yeah, thanks. As I said, we haven't thought about linking multiple addresses. And we're thinking how, as I said, how do you identify them easily? And I mentioned that we possibly would want to connect them to wallets, instead of to link multiple addresses. But I guess, we haven't thought about that. Then thank you very much. This is actually quite interesting.
And Meng asks whether you've traced any addresses to any particular crypto exchanges, or if there is a
no, and not yet. Although all the addresses we picked, and we possibly pick from different exchanges and we verify, but we didn't go back to see how they behave on different exchanges. So, for example, I think I know what you mean. So, for example, if you look at the Bitcoin prices or liquidity spread at Coinbase now and Coinbini now, they possibly, 1,000 times different. The spread on one can quite become big, but on the other is quite small. But no, I also don't see, at the moment, I can't see why we need to match every single address to different exchanges yet. So unless, for example, if we capture some addresses like in the top 5, if they are highly speculative and if they even kind of have some crime behavior, and you can trace down this address and you can trace and match all their activities across different exchanges. See whether they do cross-exchange speculation or arbitrage or things like that. But other than that, I think it will be quite a big task for no reason sometimes.
Okay, and I think one final question. Are the transaction costs for Bitcoin considered large or small?
Apparently in this, Nikolai, you can see we haven't even considered transaction costs. We only know that comparing to the conventional trading, the transaction cost is lower. So, for example, if you trade Bitcoin on any of those exchanges, the platform fees would be a lot cheaper than any kind of platforms allow you to trade equities. And another thing we didn't say is that, by design, none of the conventional assets allow you to own fractional. So, for example, fractional shares. Yes, for example, eToro allow you to buy fractional shares, but then there's a lot of issues. For example, how they pay you dividends and what's the ownership and the rights of that shares. But with Bitcoin, you actually can own fractional. Now it's worth of still at the kind of $43,000 mark. Who's going to, normal people like you and I, academics, right? They put all our spare money in. I don't think I can easily own a couple of coins, right? But you can do fractional coins.
Okay, that's great. Thank you very much to everyone who's come along, and thank you very much, Maggie, for a really fascinating talk. I definitely feel like I understand a little bit more. Yeah, if what people want to, there's the applause button, which I assume everyone is going to press. So thank you very much. There's lots of applause. He's now come up on screen, which I think is completely understandable. If anyone wants to come on the microphone and clap along as well, you can do. It's quite hard on these, but thank you for a wonderful talk, and thank you to everyone for coming along. And thanks for kicking off our new year of talks for the special interest group.